Hello, everyone. I'm your host, Cam Webster, and welcome to The Art of Boring, the podcast where we dive deeper into Mawer's investment philosophy and thinking in order to help you, our listeners, become more informed investors. Ultimately, we hope to connect you with the people at Mawer who find excitement in delivering on Be Boring, Make Money. On this episode, we speak with David Ragan, portfolio manager of Mawer's international equity strategy. We get a feel for the current investing environment, what changes have been made to the portfolio as a result of that, and highlight holdings in the exciting worlds of nano memory chips, door locks, and materials. Enjoy.
This podcast is for informational purposes only. Information relating to investment approaches or individual investments should not be construed as advice or endorsement. Any views expressed in this podcast are based upon the information available at the time and are subject to change.
Welcome to the podcast. We have today Dave Ragan from our international equity strategy, and he's here to give us an update on the portfolio. So kind of playing the plan here. Dave, what's going on in the non-North American market maybe is keeping you up at night these days?
I mean, nothing's keeping me up at night. Typically we focus on having the good companies, good management teams, reasonable valuations. So, I mean, if you have a good company, hopefully they can react. They and the management team can react very well to any sort of outside shocks. So, you start with a good company. You don't worry as much about things that, they don't keep me up at night, but there are risks and kind of aggravating a little bit when you can see how it hurts the global economy and hurts the average individual. The trade war between China and the US is obviously, seems to be in the news every day with some new level of tariffs being slapped on. And I mean, there may be the perception that this helps American individuals, and maybe it does help some, but I mean, overall, you're going to end up paying more for products because they're produced in a place that's less efficient, produced in a place where there's higher labor costs. It's a net negative for the world, and I personally really hope there comes to a reasonable end. There's that going on. Obviously, Brexit has been a few years of just a bit of a headache, no clear deal, and the EU doesn't want to give them a easy, clear deal because they want this to be a punishment. They want the rest of the EU members to see if you try and leave the union, it's not going to be pleasant, and this will keep the union together. They have to do this.
I'm hearing maybe two big risks that you're trying to manage within the portfolio, but I mean the line that we pick good companies and hope that management can work through it. Maybe expand on that a little more. Like, I hope we don't just rely on management and say, okay, you guys deal with it. We're actually probing and so maybe some examples in terms of China-US trade war, what impacts potentially are there in the portfolio on that?
Yeah, I mean, we definitely don't just hope things work out. We do probe, but I mean, fundamentally, the reason that we like to have strong companies, especially that have pricing power, is you don't know what the risk next week is going to be. So you want a company that has a very valuable products to its customers, where if their costs go up by 10%, they raise those prices 10% to their customers and there's no problem. That is a really fundamental core risk mitigant where you don't know what's going to happen. So what we have been doing is obviously these are not new. Brexit's been going on for a while. Running up to when this was announced, there was going to be a vote, and the polls coming out saying that, there's a 52% chance that they stay, and they go up and down. And I mean, we don't have any advantage in calling that, so we weren't trying to call if this was going to happen or not. Our first steps was talking to the companies and making sure that generally you have production on mainland Europe if you're a UK company, if you have customers in mainland Europe. So you match production and where you sell. That's a very easy way to negate the costs here. We did a little bit of trimming in some of our UK specific stocks because obviously in this time of uncertainty, there's a very high likelihood that the pound would suffer, and it did after the vote went to exit. But yeah, the core mitigants were the businesses themselves made the right choices of having production where they have customers. They had very valuable very valuable products, which customers will and have been paying higher prices for if this was an increased cost for the UK producer. But then the night of the actual Brexit vote, when it went a different way than the polls had implied. Our reaction was, well, we know all our companies in our portfolio. We know the impacts. And, a few of the examples, Croda actually probably benefits from Brexit because they have more R&D based in pounds and then more sales around the world. And their products are the exact products I was describing before. If their prices, they think they're going to go up 10% in the next 3 months, today they'll raise the prices 12% just to make sure. They have amazing pricing power. And then their costs of goods sold, their cost of R&D relative to the sales has gone down. So their margins have actually expanded thanks to this. So that night we were buying Croda, we were buying Intertek, which is a testing company around the world, based in the UK. So it absolutely got hit, the share price, but the actual value of the company didn't change at all. So there was a lot of good buying opportunities that night because we took that fundamental bottom-up view. I'm assuming index investors just absolutely hammered the whole index. So passive investing doesn't care about the companies that are benefiting. Some are being hurt. Some are being, it's neutral for them. An index just sells it all. We got some benefits from those passive investors probably just blasting out a massive portfolio.
Okay, so that gives us some perspective on dislocations in markets actually creating opportunities if we have these companies that we know are resilient over the long term. Maybe we can transition a little bit from Brexit and when the vote came out and here's how we went to March 2019. We don't know what's going to happen.
Honestly, no idea any more than anybody else. This is trying to tell the future. We could spend a lot of time trying to get that crystal ball working, or we could spend our time finding better companies and understanding that the businesses we've been checking this, that they're fundamentally pretty solid. And, the ones that are more UK focused, we have a pretty good margin of safety on valuation. So no, I'm not going to make a prediction. I don't know if it's going to go through, what's called a hard exit, or if there's going to be a quasi deal, or if they're going to say, hey, people really didn't understand what they were voting for originally in the should we exit the EU or the EC vote. So let's give them another chance. Now that they kind of understand what it is, they understand the implications, they understand sometimes that some of their workers may have troubles remaining there, that some of their suppliers or customers are going to raise the prices, or there's going to be increased cost of actually doing business, and they might have to cut some of their staff, or they might lose their own jobs. There's a lot of implications people are probably a lot more aware of. I'd love it if they did another referendum. It's probably not likely. But this whole process being painful is a net positive to the EU in general, because the rest of it should have a more likely chance of staying together.
That's a good perspective. Let's shift a little bit to emerging markets, the importance of emerging markets in the portfolio. The component within the portfolios come from about 20% to 17% now. So still a decent weight, but it's declining. So help us understand why it's declining. Are you making portfolio moves to do that, or is it just share prices coming back? Help us with that one.
There's definitely been active actions by us to reduce the weights of some of these stocks. There's been some great stories where we've had a stock, it's done incredibly well, so we've been selling them on valuation. So Clicks Group out of South Africa is one example there.
What do they do?
They're a drugstore company in South Africa, consolidating, growing very rapidly, very well run. They actually have some of the management team of Boots, which is the UK's Shoppers Drug Mart.
Sure.
So, they understand that you put the pharmacy at the back, you take 20 minutes to fill a prescription, and you have people walk around cosmetics and other very high margin products. Where the traditional pharmacy is typically just a pharmacy. And that means that you have to get a lot more profits from filling prescriptions rather than make the profits elsewhere. And, there's a lot of benefits to society and the country to have very efficient pharmacies that don't really need to make their money at the back of the pharmacy, and they can roll out around the world. So that's what Clicks has been doing very well. It's just got quite expensive. I don't know if there's an impact of it's in South Africa. It's an absolutely stellar company, especially relative to a lot of the rest of the index. So if you're a South African investor, you have to invest in South Africa. This has got to be top of your list, and you're going to overpay for this one because you'd rather own that than some of the other terrible companies.
Really? There's terrible companies in South Africa too?
Well, there's terrible companies everywhere. fundamentally, I think one of our biggest advantages is that there are terrible companies out there, and other investors, they're trying to guess when this terrible company is going to go from, very cheap or doing very poorly to some people might try and bid up the stock. And that's not saying the value of the company is higher. It's just people are trying to guess when somebody else will buy it. Or there's a short-term boost for this company for some reason. And we don't. We have that. Our client base, we've been very clear, is we're long-term investors. We're not going to invest in every sector in every country. We're going to invest in the good quality companies wherever they are. And core to this emerging market weight that we have at all is because they're good companies. We didn't buy Clicks originally because we thought we want some emerging market exposure. We want some South African exposures. No, we bought it because it's a fantastic business, solid management team. Characteristics of it being in the emerging market means that there's a lot of growth potential. There's a lot of more drugstores that they can build, and there's that long growth runway. But on the negative side, you have a lot more issues with the government. You have a lot more volatility in the currency. And, typically in a crisis, the money travels back from all the markets around the world, back home, back to the stable markets. Japan, the yen goes up. Switzerland, the franc goes up. The US dollar goes up. People bring money home. So you get share prices going down. You get FX, the currency prices going down. That's a risk we're very aware of. It's been a secondary thought in some of these trims. The primary has been, let's harvest some of the capital that's gotten a little bit expensive, or in expensive companies in some of these emerging markets. So yeah, we sold Clicks, we sold B3 Group in Brazil, the stock exchange. Those ones were on valuation. And there's been a few other trades similar to that, and a few other trades where we can just reduce the risk, overall risk of the portfolio, which EM doesn't contribute a little bit more to, and keep a similar return profile actually if we move it to some of the newer ideas in Europe.
So Clicks and B3 are mostly valuation calls, but on Clicks, which is a really interesting story, how did we actually find that stock? Because you described it as a really great business, but how did we find it?
The way we found Clicks, it's a little bit unique to the Mawer platform because we have one investment philosophy and we invest around the world. So our Canadian team were investors in Shoppers Drug Mart, and it really highlighted the quality of that business model. So, this happens often where one team will find an interesting business model, and I'll always say that great businesses transcend borders. So we looked around the world and actually found Clicks because of that.
Did they tell you specifically you have to find drugstores that have pharmacies at the back?
No. They talk about their investments, any new investments. We have a research meeting where every Wednesday the whole research team is in the same room talking about companies. And, sometimes we do what we call the 3-minute drill, where someone talks ironically for about 8 minutes on a company. And
it's a good goal, 3 minutes.
Yeah. It's not easy to get a lot of detail in 3 minutes, but it's the goal. But you get that intro to a different company. And I think one of the weeks they talked about Shoppers Drug Mart. And you saw that this is a pretty good business model. You can roll them up, you can consolidate the industry and get a lot of benefits there. So we actually found two. We found Clicks in South Africa, and then we found Tsuruha in Japan, which similar business models. Clicks has a lot of growth because, it's just an underdeveloped business in the country. And then actually Tsuruha, even though Japan is incredibly developed, they have a lot of consolidation options because it's a very fragmented industry. There's a lot of smaller players that Tsuruha is able to consolidate and get a lot more efficiency out of those sites. Okay,
so actually off of one idea in the Canadian market, we got two ideas in the international portfolio. It's interesting. Maybe the dissenting view would be, well, wait a minute. Yes, you guys have a process and philosophy, but are you picking specific companies or are you just picking business models?
Well, they're very much intertwined. A company is a business model that incorporates where you apply that business model on the management team doing it. But then, the third piece of your comment is it's got to be a good investment, so it's got to be valuation. But that goes back to our philosophy. Business model is a core part of it. Make it a good business is where you operate and who's operating it. And then finally, don't pay too much and you've got a good investment.
Let's dig in a little bit more on the process. So your process encourages focus on inputs. That's what we We do. So
we can't control the outcome necessarily all the time, but we can control what we put in. Yeah.
Right. So the big inputs are adherence to the process and improving the process.
Yeah. That is actually even part of how we bonus our analysts here and all the research individuals is, a third of it is on improving the process because, like you said, we can't control all the outcomes. It's a very random world. It's a very uncertain world. And there's a whole podcast on the difference between risk and uncertainty. So, we really focus on people working hard, following the process, which we think over the long run should work. And then, of course, improving the process because, well, in all honesty, when I started here back in 2004, nobody knew more investment management. Calgary, maybe. Someone might know you, but most likely no. And then definitely the rest of Canada, no. Now I see our presentations, some of our work popping up around the internet with other clients and things like that. So, people are seeing what we're doing and there's other individuals copying some of the things we're doing. So if we stood still, we'd probably lose our ability to create alpha. So we're always pushing on how we do the process, do it a little bit better. I mean, obviously, the big effort is actually just on applying it, looking at more companies, doing more research, doing more calls with management teams. But we're always trying to make it better. And, there's a lot of improvements that we've done over the last year. It can be something simple like a framework where you break out a little bit more about how ideally one does scuttlebutt. I mean, I think there's been a podcast on that already, so I don't really need to go into a lot more detail. Wow,
you're just a running ad for the podcast here, Dave. It's awesome. So improvement. Give us an improvement.
Yeah, I mean, the improvements, we actually now currently have a DCF model for every stock in the universe because over the last year, we've been trying to create a model that's smart enough to generally create a decent model to get basic valuation on every single stock in the universe.
Okay, just pause there and give us a sense of holdings versus universe. Like what percentage of universe would be holdings?
Well, in the international fund, we have 60 stocks, plus or minus usually. And then the universe for international the whole universe, including the US, I think is around 20,000 stocks. So you can do DCFs on 20,000 stocks? We have DCF done on 20,000 stocks, yeah. When you get a computer to do it, it's a lot faster. And, these tools, they are tools. If we ever buy a stock or invest in it, we do our own DCF, because there's a lot of value in going to the numbers, going into the notes. However, when you first come across a stock and it's trading at 28 times earnings, great quality company, you recognize the business model, it's got a high return on capital. Do you work on that? Do you spend a few days or a week of your life working on the stock, or do you pass it off because it's too expensive? Last year, the year before, it maybe take you a few hours to make a rough DCF model. Now there's a very rough one done, and the intention is to make that smarter all the time. That's been a big benefit. We're always pushing it on building out our inventory, having a bigger list of high quality companies, and making sure that we get a notification when this high quality company's valuation becomes a bit more reasonable. So, and this has been another push of ours because we do have a lot of work already done on a lot of companies. In the international universe, realistically, you're probably about 6,000 companies that have a sufficient market cap outside of North America. So it's still a huge universe. So this was an area that we've identified that we had to improve, and we have, and we'll continue to do more.
All right. That's really enlightening, really interesting that we've gone from a few hours of work to maybe minutes in terms of
zero. It's already done.
Just open the file and it's there.
M42 is our kind of our hub as research. It's got all our knowledge on the companies. It's got valuation work. It's got management meetings. It's got everything there, and it's already there. So you open up the company, you see if anybody else has done any work on it, you see what the valuation is currently. So it's done.
Pulls it right in.
Yeah. Oh. If you want to go edit and change some of the assumptions, you can do that. That's just, again, a click of a button. Excel opens, you're done.
Okay, Dave, that gives us really good perspective on the tools I guess you're using to make the process more efficient. But from a decision-making point of view, maybe give us some context on why travel. Why do all the travel if all the tools are at your fingertips now?
Yeah, I mean, there's so many individuals in research now that it's really going where nobody else has gone very recently. There's a lot of travel going on. We've got 2 analysts in Singapore. One was just in South Korea. Another one's going to be in Japan very soon. There's a lot of trips those 2 are doing to Asia. Individuals in our Calgary office are always on the road as well. There's been a few trips to Asia and lots to Europe. Everybody spends probably 1 to 2 weeks, 1 to 2 times a year traveling for these trips. Some do more, some do less. So yeah, you're going everywhere. And yeah, we're not looking at necessarily the valuations of this country are suddenly looking attractive, because that doesn't really happen that often. The market's typically more efficient than creating a big opportunity in a specific sector or country, which, I mean, when you ask an investor, what sectors do you like right now? At least for me, it's the question I get all the time, but it's
Dave, what sectors do you like right now?
Yeah, it's almost never. It's like, if the market was that inefficient, this job would be easy and
right.
People can make everybody can make a lot of money, which would make it actually take away all the alpha. We, I think, create alpha because it's not easy. It's difficult, and it's, stock by stock. It's some little nuance that the market's underappreciating, or the market just makes behavioral issues and thinks that, this business is good for now. But I mean, obviously, I'm going to get out of the stock before it craters, because I'm smarter than everybody else, and everyone's thinking the same thing. So yeah, when we do a research trip, it's the encouragement to all individuals from the team is get out there, go see a lot of stocks, go talk to the companies, but also go see facilities, go see the plant. That gives you a lot more depth of knowledge of what the business actually is, how it works. And also you get a lot more, you get some confirmations of what management says, or you can refute what they say. They say we care about safety, and you go to the plant and there's some very unsafe practices that you have less trust in management, or you can see how deep the KPIs, so the key performance indicators that management say we focus on this, how deep do they go? Does the plant manager have his own KPIs that he is in control of that match these ones that were espoused by management, or does he not? I mean, it's the more you see a company, the more areas more checks you can have on what was said, and also just the better understanding of the competitive advantages you can get.
Awesome. I think we've touched on a bunch of the process, a little bit of why we travel, some of the technology tools we're using. Why don't you mentioned something called a 3-minute drill. Give us a sense, maybe a couple of names that I think would be interesting to talk about would be Samsung and something called Assa Abloy. So why don't we do, as best we can, 3-minute drills on those 2 companies? So Samsung first, go.
Sure. Samsung Electronics, because you have to say electronics because it's part of a big chaebol, as they're called, big operating group in South Korea. You see them on TVs, you see them on the phones, but really what this company's core, most attractive asset is its semiconductor making. I mean, there's not a lot of companies in the world that can make semiconductors and make the latest and greatest, which, I mean, it all entails making chips that are smaller, and the pathways that the electrons go down are smaller and makes them a lot more faster and energy efficient. But these are billions of dollars to create a fab and to get it working. And that was the original reason we've bought Samsung as well. The memory business is particularly strong with Samsung. They make the 2 types of memory, the DRAM, which when you turn off your computer, the memory's gone, and then the NAND, which would be in your iPhone, that is the hard drive. It's the solid state. You turn off the power, the memory's still there. These guys are inside pretty much a lot of computers, a lot of phones. And these chips are very difficult to make. So, we saw this competitive advantage with Samsung that they can make these chips. They can progress to the next smaller chip. And it's very costly and very difficult for anybody else to do this. And we made this hypothesis years ago, and it seemed to be true. And we got some actually more recent information that, yeah, this seems to definitely be the case, because, one of the other entities that was trying to move on to this smaller chip, smaller pathway, they've just decided not to do it because it's too hard. It's too difficult to make it work and get a good yield out of every chip you try and produce.
So is Samsung's competitive advantage there driven by technology in nano, or why would that other competitor leave other than, it costs too much, or is it actual expertise?
It's ironic that everybody buys the same equipment from the same company, ASML in Holland, and it's more about actually be able to apply the process to really get the yields. spend millions and millions and billions of dollars trying to get your factory running where there's hundreds of steps to create one set of chips. It's a big circle piece of silicon that you use lithography, light to print the chip. And to do this successfully, to make it so all these chips work on one of these silicon wafers is very difficult. And as you get to the smaller wavelengths, there's smaller pathways. Regular light doesn't work anymore. You have to use UV light because the wavelength was too big on regular light. So now you're working with more and more tighter wavelength lights. It's just adding more and more complexity. It's making it more difficult. And then, you have a big wafer and you have a lot of chips that don't work. The economics don't work. So all this process excellence in making these work and the track record and the knowledge you've gained over the years, that is a big advantage of something like a Samsung or a TSMC, Taiwan Semiconductor. It's another one in our portfolio. And that seems to be leading down the pathway where the smaller and smaller we go, the less and less players can do it. It's a solid competitive position, I would say. The valuation is pretty attractive. It's a very volatile business, but I think it's probably less volatile than it was historically because you've had more consolidation. You have less, I would say, volatility and new supply coming on and new supply building memory coming on. So it's probably going to be a little bit less volatile than it was in the past, and that's potentially underappreciated by the market.
And what's the major risk for Samsung? Where could you be wrong?
Well, technology risk is always something that gives you a little bit of heartburn. You can't know. Semiconductors right now are made on silicon. They're a certain process. Who's to say that it's always going to be the same way? And, quantum computing it's out there. People are talking about it. Maybe it happens. Maybe that's the way everybody goes. And this new chip opens up, or this new process opens up this industry for somebody else. Or, there's 3D memory coming out and the existing players are doing this. But again, technology is always a big question mark. The capital allocation of the company, they have a lot of cash sitting on the balance sheet. It's not necessarily a risk that it's there. They could waste it, and there's been other companies that have had a bunch of cash sitting there and they waste it. Most likely they won't, but we would like to see a better track record of capital allocation. So we'd highlight that is another risk that we have in the portfolio, or risk that we have in the holding, and something we watch. And, if they get better, shares should do extremely well. They should really re-rate. But if they don't, then there's a huge cash hoard that's just sitting there as a drag. And then obviously the end markets are volatile. It's computers, it's phones, it's discretionary spending. There's obviously some structural themes behind it, but it's cyclical. And, when this fab it's all fixed cost, it's not really variable costs. So you cut down your demand a little bit, prices of memory just crater.
Okay, you give us a really good balanced view of here's maybe the bullish case, here's the risks we're worried about. Those risks, I imagine you talk to management about regularly, so you're always getting an update and making a judgment there. Let's shift gears a little bit. I don't know how long it was, but it was more than 3 minutes.
I was interrupted though.
Ah, good point. Touché. All right. Assa Abloy. Where the heck is this company from? Why is it named that way? What does it do?
Yeah, Assa Abloy is one of the world's largest lock, or they call it access controls systems. But you'll probably
door locks?
Yeah.
Oh, as simple as door locks.
It could be door locks. It can be, those magnets that hold the doors shut, and, the scanners that allow people in and out of buildings. Yeah, that's them. Pretty boring business in a hotel. Obviously there's hundreds of locks, and they're one of the major makers of that. So, it's not a very complex business. It's still actually reasonably fragmented in a lot of markets around the world because you have some local lock maker. And
is that right? Fragmented in locks. I wouldn't have guessed that. Sledge. It's the only name I know, but not Assa Abloy.
Yeah, those brands are all owned by some other major one. And it's more concentrated in certain areas. Definitely in the developed markets, much more so. But you can still buy a lot of local brands, get rid of the this local production that's inefficient, move it to the Assa Abloy platform. Some of the things that are attractive about this is, locks, there is a good portion of the business that is, new build. You build a new building, you have to put in locks. That's obviously very cyclical. Not a lot of buildings get built in a crisis. But if you have an office building in the middle of the most terrible crisis ever, and your front door lock stops working, are you going to defer buying a new lock then? Or are you going to buy it right away? And you're going to buy the exact same kind that you had in the rest of the building because it's all connected. It's one key that's used in all these areas. It's one card that's used in all these areas. It's one software system that's used. So, I mean, that's a very stable business. And again, distributors sell these to the locksmiths the locksmiths just pass the price on to the end customers. They don't care as much about the actual price. So there's not a lot of negotiations there. And then the end cost to the consumer, it's probably more labor than it is actual end cost of the product.
What's the growth path for them?
How many years has it been since you've had a physical key to get into a hotel room? And yeah, the cards are getting a bit easier and easier. This is also moving to households where you may have a smart door, a smart lock, maybe even be tied to your smart home in general, where if someone's there, you can unlock it for them. Amazon package comes by, you can actually open it up for Amazon. There's a lot of talk of this in the future, and maybe it happens, maybe it doesn't. But yeah, one of the core questions or the things that people don't seem to talk as much about is, especially if you go to Europe, walk around the residential areas and look at the locks. I mean, these locks are 50 plus years old sometimes.
Yeah.
But
maybe
just
more.
With an example on the hotels, we've gone from sliding the card to touching the card in a relatively short period. So they've replaced those locks pretty quickly. With radio signals, like Wi-Fi connection, you can't really have a device that's 15 years old because it won't connect anymore. It won't work. So the replacement cycle potentially does increase materially from, we buy it once and then it's there for pretty much ever until it breaks, to, we got to replace them every 5 to 15 years.
Good. That gives us a good picture on what Assa Abloy does. Risks there? Just cover them quick. Yeah,
I mean, the risks would be, there's a portion of the revenues that are cyclical. The company has faced intense competition in China, and they've had to adjust down some of their growth and profits in the short term. I mean, longer term, it probably plays out like most other markets, but there is some short-term pressure there. The smart homes and the Googles of the world, Apple, everybody wants to have their own smart locks. But right now it's really Assa Abloy or one of the other majors is making those locks. There's just a piece of software attached to it. It's pretty unlikely that Amazon and Google and Apple want to deteriorate their business models by making locks. They have better business models. They have higher returns on capital. They don't want to really get into this business. They potentially could try to, which would be a little bit disruptive, but I think that's a lower probability risk.
Okay, thank you for painting those two pictures, Samsung, Assa Abloy. I think we're ready for one more thought. If you look through the portfolio, international equity has a pretty large weight in a small country in Sweden. Please explain that, Dave.
Relative to the index, we do have a much higher weight in Sweden. And, what we found is that there's certain countries around the world that just the management teams are consistently better. And, I'll often say, I think there's something in the water in Sweden that just makes a better manager. The average Swedish manager is quite good. They allocate capital well. It's a small country, so they quickly realize that they're going to go international, and you find a lot of great companies that are based in Sweden, operating around the world, good capital allocation. And again, the index doesn't care about that in weighting its stocks and its countries. So that's one of the reasons why you'll probably find us in Swedish stocks a lot more than elsewhere.
Okay. I don't know how to say thank you in Swedish, but thank you in Swedish, Dave. Thanks for joining us. Thanks for giving us an overview of the international equity portfolio, and we will have you on again sometime soon.
Thank you, and you're welcome.
Hey everyone, Cam here again. To subscribe to the Art of Boring podcast, go to Mawer, that's mawer.com/podcast. If you enjoyed this episode, leave a review on iTunes, which will help more people discover the Be Boring, Make Money philosophy. Again, thanks for listening.